Good morning. Welcome to Stock Market Today. It's Thursday, November 29th, 2018. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and StockCharts TV. And you can sign up, receive a free email to follow along with this show and receive stock ideas. Head over to ChaikinAnalytics.com/today. So stocks rallied for a third consecutive session following comments from Chairman Jerome Powell. Powell's speech in New York was considered dovish as it included comments that the Fed funds rate being just below the neutral level. Major markets in the U.S. all moved higher by more than 2%, with the NASDAQ leading the charge. Technology and consumer discretionary were the best performers, while defensives and the commodity sectors lagged. Utilities actually were the only sector to finish lower on the day. Treasuries were mixed with a bit of curve steepening. The dollar was weaker on the major crosses. Gold finished up 80 basis points, and WTI crude settled down 2.4% after another weekly inventory build. And as we get to the desk today, we're giving some back. S&P futures are down 20 basis points following that big rally. Asian markets were mostly higher overnight, though interestingly, China was weak. European markets were higher. Treasuries are stronger across the curve, and the 10-year yield is actually close to 3% this morning. The dollar is outperforming the euro and sterling, but lagging the yen. Gold up 10 basis points. WTI crude up about 1.5%. So here's the structure. Nice big rally over the course of the past 3 days. Next test is going to be the 200-day moving average at 27.61. And what's interesting is the 50-day moving average is actually close to, not at, but close to that level as well. I didn't want to crowd up the chart, but could provide some interest in some near-term resistance. The positive divergence at the recent lows remains a bullish sign in the near term. Chaikin money flow remains bullish, and what we're starting to see, and we'll take a look here a little bit later in the show, we're starting to see some breadth divergences appear that could be constructive into the end of the year. So let's just keep an eye on that. But a nice 3-day rally, obviously. Futures down a little bit this morning, so we'll see if it can stabilize and continue to work higher. But I think we're going to have some work to do over at around the 200-day moving average. So your market in a minute. This is what I'm talking about in my note to Chaikin Analytics members today. Chairman Powell's dovish tone sends stocks higher. We hit that. Risk-on sectors outperform and the defensives lag. We'll actually take a look at the technology space because that was a big outperformer yesterday. 10-year yield test 3% here this morning. Breadth metrics beginning to flash positive divergences. And futures, as I said, do point to a lower open. So we look at the Chaikin power bars for the major indices. We could see, across the board improvement. 7 of 4 in favor of the bulls for the Dow, which added 2.5% yesterday. S&P 500 up 2.25%. 79 bulls, 77 bears. So that one actually flips to a bullish ratio on the day. NASDAQ 1618 bulls to bears, but that index was the outperformer, up over 3% yesterday. Small caps outperformed the S&P 500 by about 20 basis points, but that power bar ratio is still skewed to the bearish side of the coin. 215 bullish or very bullish stocks, 459 bearish or very bearish stocks. And here's tech, big outperformer yesterday, 3.5% to the good. But look at that power bar ratio, 2 bullish or very bullish stocks for 11 bearish or very bearish stocks. So when we roll it all up, according to the Chaikin power bars, small cap stocks are more bearish than large cap stocks, and the major markets are mixed. Our stock of the day, if you're following along that email at home, this is one of the stock ideas that we will generate for you using our proprietary Chaikin Power Gauge rating. Today's stock is Amerco, ticker symbol UHAL, comes to us from the Transportation Industry Group. Closed at 348.41 yesterday, up 50 basis points, so big underperformer. But the Chaikin Power Gauge rating is very bullish due to very positive expert activity, strong earnings performance, and strong price volume activity. When we roll up the 20 factors in these 4 categories, we come out with this very bullish rating. So let's take a look at our analysis. Very bullish stock, strong trend, but a weak industry group. Market and model are in agreement, and this is what we call a personality change. We go from underperforming to outperforming. That's a bullish personality change. Market and model now in agreement. Dynamic duo in gear. But the tactical side of the coin is just not there yet. Stock's actually overbought, rallied from about $310 to $350, creates an overbought condition. And in that overbought condition, Chaikin money flow remains bearish. So I like premium setups in this environment. This is not one of them. It's an interesting name. I like the personality change. Certainly going to keep an eye on it. We'll add it to a bullish watch list. But I don't think the tactical setup is there to enter a long position in the stock right now. Add UHAL to a bullish watch list. Turning now to the sector tracker, movement over the last 5 days for the major market sectors. You can see the risk on tone of the market as we've rallied for 3 days in a row, especially with that big move yesterday. Discretionary and tech moved to the top of the pack. Healthcare also at the top of the pack. That's the one we've liked the most. Communication services rounds out the top 4. And your defensives, as you would expect in a risk-on type environment, your defensives begin to lag slightly. And remember, on Tuesday, I started pointing out how the defensive sectors on a relative basis looked a little stretched in the near term and needed to consolidate. That theme is playing out. Staples, Utes, and REITs move down the list a bit. Materials and energy, your commodity complex equities do remain at the bottom of the list as oil the main driver there. Our industry in focus today is innovative technology services, which over the past 6 months has underperformed the S&P 500 by 8.5%. And that power bar ratio, which measures future potential, is weak. 2-to-1 in favor of the bears, 21 bullish, bearish or very bearish stocks, 10 bullish or very bullish stocks. Group is currently ranked number 9 of the 21 subsectors we look at, and it has moved up 2 slots over the past week. Some of the indicative names in that group that you might want to consider if the setup is there for potential bearish ideas or to sell them from your portfolio if you own them. Pure Storage, PSTG, Everbridge, EVBG, and Quotient, QUOT, all have very bearish Chaikin power gauge ratings, and we'll take a look at Everbridge here today because I think it's going to present an interesting opportunity. Very bearish stock week, trend week, industry group. Underperforming the market, so the dynamic duo in gear, market and model are in agreement. So we know this is the type of name we don't want to own. The question is, when do we want to get it out of the portfolio, or when do we want to think about opening positions to the bearish side? And I would say tactically, we're not there yet. Money flow is bullish. Stock is oversold. So that's not the setup we're looking for to open bearish positions. But this is interesting to me because, as I wrote the other day, software has gone from a leadership group to a lagging group, and this is really indicative of that. Look at this stock. Nice steady uptrend throughout the bulk of 2018. Outperformance the entire way until recently. Theme that's playing out. Momentum names, high beta names have started to underperform the market. We'll see if yesterday's rally changes that. But one day does not a trend make. And now we're rolling over. We're below the declining long-term trend line. I think you'll get a setup here to open a position to the bearish side. I just don't think it's today. Wait for the stock to become overbought. I'd like to see money flow go negative as well. Taking a look at what's trending now. Yesterday's S&P 500 gainers and losers. Salesforce.com. Solid earnings report and good guidance on that stock, up 10%. Juiced, in no doubt, by the risk-on environment yesterday. Adobe follows along. A lot of the SaaS names, that's software as a service, rallying with that CRM print yesterday. Abiomed and Align, 2 of the former med tech momentum leaders that have really been hit hard during this market sell-off, getting a bit of a rebound. Both of those stocks rallying by about 6.75%. FCX, Freeport-McMoRan, neutral stock up 6.5%. Didn't really see a ton of news to send that name higher. Tiffany on the loser side of the board now. Tiffany down by nearly 12% as investors did not like what they had to hear on their earnings announcement. Remember, one of the themes that I've been talking about is high-end consumer names, especially those leveraged to China, remaining under pressure. We saw it with Ralph Lauren. We're seeing it now with Tiffany. As a matter of fact, when Ralph reported, I called out Tiffany specifically and said, be careful there. SJ Smuckers, SJM down 7.24% following their earnings announcement. CME Group catches a downgrade from a sell-side research shop, sends that stock lower. Scana SCG, it was on the winner side of the board yesterday, moves to the loser side of the board today. Didn't see any real news to drive that performance. And Western Digital WDC down over 2.5% when they announced that their CFO will be resigning. Investors don't like to see C-level executives leave, especially the CEO and CFO. So that stock came under pressure. And if you think about it, 2.5%, but massive underperformance with the markets all up 2.5%. So underperforming by 500 basis points on the day due to the CFO leaving. So as I said, risk-on sectors lead. Led yesterday. Here's the XLK, great example of that. It's had a nice rally off the lows here, but remains below the 200-day moving average. What's interesting to me is that tech is one of the groups that actually undercut their October low. But look what's happening. Positive divergence. Remember yesterday we started talking about positive divergences at the index level. We're seeing it at the sector level as well, as XLK, when it made the low during the Thanksgiving week, did not make a lower low with the RSI. And look at XLK relative to the S&P 500, now testing support from back earlier this year on a relative basis. I think that's an interesting development if it can continue. Listen, in downtrending markets, rallies tend to be fast and sharp. Right. So while yesterday was a great starting point, we're starting to see some divergences. We really do need to start to now see key resistance levels be taken out. And I think the test really is going to be the 200-day moving averages for most of the indexes, as well as these former leadership sectors. So we'll keep an eye on it and watch what's happening. But the beginning stages are there. Beginning stages are there. And we're starting to see it at the index and sector level. So keep an eye on tech, obviously. But this is still a downtrend. The divergences are important, and we have sat up to take notice. 10-year yield testing 3% this morning. Dovish comments out of the Fed. You would expect yields to head lower. But look at what's happened here. We saw the breakout through 3%, hit our heads on 3.23% a couple of times, and now faded. Back below the 50-day moving average, but above the 200-day. Here's that key support level at 3%. We're about 3.02. This morning, and actually traded closer to 3.3 as I was heading to the office today. But look what happened on the retest of the high. Big negative divergence with RSI making a lower high and now moving into bearish ranges. Would not be surprised to see yields continue to churn here. If they do break 3%, I think they could head back down towards 2.8% in a fairly swift manner. And obviously that would help. That would actually help your bond proxy sectors in the S&P 500, that would be real estate and utilities. Positive breadth divergences. That's what I'm talking about in my note today to Chaikin Analytics clients. Thursday is breadth day, and we are seeing positive breadth divergences. And I'm going to go through a couple of examples here today. First, here's the percentage of stocks in the S&P 500 above their respective 200-day moving averages. Look what happened here. Breadth breaks down with price here and makes a low with the October lows. Rallies back with price, falls. But while the S&P 500 actually undercut its October lows, the percent of stocks above their 200-day moving average did not. Here's your positive breadth divergence on that metric. And then when we look at the S&P 500's advanced decline line, we can see something similar to what we saw in March. Market tested lows, advanced decline line made a higher low. And now we're seeing it again. October low in price. Rally, price makes a lower low. Advanced decline line makes a higher low and is now actually on the verge of taking out this interim term rally here. That is another example of a positive breadth divergence. If we combine that with the momentum divergences that we were talking about in our note yesterday, I think you have the building blocks for a potential rally into the end of the year if the S&P 500 can take out its 200-day moving average. That, to me, is the key. We're going to be watching it closely. That's it. Sign up for the email, ChaikinAnalytics.com/today. Follow along with this show. Get stock ideas for free and help us spread the word. Share our link on social media. I will see you back here tomorrow, 9:15.